But Jashandeep, Chadha, the CFA and equity research analyst, cement and metals from Nomura is joining us on the show to talk to us about what exactly is happening in this sector. Hi, good to be speaking with you, and best wishes for 2025. But is it going to be a better year for the cement pack when it comes to 2025? Because finally there is some pricing power which is emerging. Consolidation has happened. Would you bet your money on a bit of a revival here?
Yeah, hi. Good morning, and thanks for having me. And happy New Year to you. Firstly, I'll just want to say that there is some price recovery we have seen. We did our channel checks in January. We found that the prices are some 2 to 3 rupees per bag increase in January. However, when we look at on a quarter-on-quarter basis, the third quarter prices are quite flattish. And even if we assume that these price hike which have been taken in early January will stick, the prices are still very weak. They are weak in the last weakest in the last 3 years, 3 to 4 years. So the significant price recovery or recovery in a matter that it exceeds FY 23-24 levels, I do not see that happening. There are two reasons why I say that. First is that consolidation phase, I don't think so is over. There is still a lot of inorganic expansion that can happen, which has been led by the leading cement manufacturers. So consolidation, while in the long term will result in some pricing discipline and pricing power for the industry, but in the short term will be a pain. Will put pressure on prices because most of the target companies are not operating at industry utilization level. So any company which acquires them would be trying to increase their utilization, push for more volumes, which will put pressure on pricing. And secondly, unlike other commodities like iron ore and aluminium, Indian cement industry has a negative correlation between volume growth and pricing. Because this industry is operating at 70%, around about 70-75% utilization. So whenever there is strong volume or a demand recovery, we have seen that major players start to break the pricing discipline in order to gain market share. So on the pricing front, we remain very conservative. We do not expect prices to significantly improve. We believe the prices will improve, but 2 to 3% YOY, largely in line with WPI.
And I mean, forget cement. The infrastructure sector has seen a boom.
Yes.
Government spending, real estate demand, and yet prices in last 3 or 4 years have been flat. Now, if with this kind of an underlying boom, both on the real estate sector and on the infrastructure space, if cement prices have been flat, when economy is slowing down, when things are progressively looking that they're slippery, why should cement prices go up? If they were not up when the boom was there, then why should they go up when there is lull?
Right. So firstly, I don't believe that there is lull in cement volumes. Yes, FY 25 has been a challenging year, but it was, more or less expected in any general election year. The new projects, new infrastructure projects always slow down. This year, the release of government capex was even slower than expected. So yes, FY 25 we expect 3% YOY volume growth. It has not been a good year, but going forward in FY 26, we believe a 6 to 8% YOY volume growth is quite possible. So on the volume front, I do not believe cement sector is in a lull or is looking weak. It is largely the cement pricing, right? And as I've already said, due to the consolidation and lower utilization rates in the lower utilization rates in the industry, the pricing will remain weak. So I believe in line with WPI, you will see some improvement in pricing coming, but I do not expect a 5 or 7% improvement in pricing, which will result in higher EBITDA levels than what we saw in FY 23 or 24.
Is that the cement consolidation has not translated into pricing power. Steel is in one example where the sector consolidated, Tata's got few, Jindal got few, and then the sector started consolidating. In cement, massive consolidation has happened. Now we can talk about three large groups, and yet the pricing discipline is not there, which could favor shareholders more.
Right. So when we are comparing, steel with cement and talking about consolidation, a key point that we need to remember is that steel players were operating at higher utilizations, right? Around about 90%, 88 to 95%, in the last couple of years. Whereas cement, on the other hand, has always operated between 65 to 70%. So the utilization levels of both the commodities are drastically different. Hence, when a consolidation happens in steel, the players are able to maintain pricing, or there is pricing power with the industry, because there is no benefit for any player or incremental benefit for any player to reduce price, because they won't be getting incrementally higher volumes. Whereas in case of cement, since the utilization is lower, 70% around, so for each and every player there is a benefit. Their incremental volumes increase significantly higher if they cut prices. So pricing indiscipline is significantly higher in cement because of lower utilization versus any other commodity. Let's say you can compare iron ore or steel or aluminum. Across the globe, you will see commodities normally see a strong correlation between volumes and pricing where the utilizations are high. But in India cement industry, since the utilizations are so low, prices do not follow volume growth. The benefit of consolidation, I believe, will come in the next 2 to 3 years, when the consolidation phase will be over and the target companies have achieved, utilization level equal to the industry or even better. Then you might see some pricing power coming in. But in the mid time, for next 1 or 1.5 year, we believe there will be pressure on pricing.
Jashandeep, good to be speaking with you. Yes, indeed, we have seen a lot of consolidation within the cement space, but just a couple of days back, we also have an announcement coming in from Nuvoco Vistas that did acquire one of these insolvency applicants. So just wanted to understand that now, is this that the top players are now eyeing the insolvency applicants? Any other targets that could be on the cards, or any company that you wish to flag off could be actively looking for some of these opportunities lying there?
I think a lot of the larger groups, top cement manufacturers, have been eyeing the companies in both in IBC and also companies which are highly levered. So it is nothing new. We believe Vadraj was, their NCLT application was accepted in February of 2024. Hence, you see resolution coming in, early 25. But companies like Ultratech or Ambuja Cement, for that matter, even Shea Cement and other companies, continuously, their M&A teams keep on looking for newer inorganic opportunities. Right. So I think the consolidation phase is not over. You might see some of big players again acquiring or going on a consolidation spree this year as well. So I believe there is about 25 to 30 million ton of capacity which is up for grab, and you might see a lot of inorganic expansion announcements coming this year.
Consolidation phase is not yet over. 25 to 30 million worth of capacity still available. So perhaps that's something that one needs to watch out for in the sector. Thanks, Jashandeep, for making time and speaking with us. Always a pleasure to get your insights on what's happening in the sector.
Thank you.
If you like this video, then like, share and subscribe to ET Now.